Welcome to the daily update, where I'll go over the action in the market for Wednesday, April 17th, and then we'll see how things look for Thursday, April 18th. Another down day. We had a positive open. Looked like dip buyers were coming in and trying to get in at some good prices, only to see things further decline as the day unfolded. We're still turning more negative. We're negative in the short term, but looking oversold. We're turning more negative in the intermediate term. However, the long term still remains positive. Let's go back and talk about what happened. Right at the open, we did have a higher open, and prices, unfortunately, put in the intraday high at R1 right after the open. And that was at 50.74, right around that level. As the day went on, then we started to fall. We went below the daily pivot at 50.57. We went below the unchanged level to go negative. We hit S1 at 50.34. We finally found support at around S2 at 50.17. So now we're starting to flirt with that 5,000 level. And then we tried to bounce back above S1. Prices stalled at the unchanged level. So there was an attempt later in the day to see a bounce, but that fizzled. And we fell back below S1 to close slightly above S2. We were down 0.58%. We're still below average with volume. As I said with our technicals, we're negative in the short and intermediate term, still looking okay in the long term. It's this whole scenario that seems to be changing, and the idea that we've just come out of a period of time where the market just kept going up and up and up and up and up, and any kind of weakness whatsoever brought the buyers in. They're trying to do that again, but it's not working this time. And so we're looking at a more substantial decline, because it looks like instead of the Fed coming in and possibly cutting rates, now we're wondering if they're going to be able to cut those rates at all. And there's even a little bit of doubt coming in that if we see these stronger than expected economic reports, they may have to actually come in and raise rates. And then we have the geopolitical concerns, which could come in and have an impact on the market. Some comments. Mega caps and semis did underperform. They had been holding up a little bit better as of late, not in Wednesday's session. Oil continues to fall, so that's not putting as much pressure on the market as it had been. We closed at $82.80 a barrel there. Our list in the short term is getting kind of long for those things that are extreme negative or even oversold. The 20-period exponential moving average of the S&P, the 20-period simple moving average of those stocks inside the S&P, the stochastics chart, the force index, the boom indicator based on 20 periods. The slope oscillator now is finally starting to get a little extreme. And then the RSI based on 9 periods, not quite there right now, but with the 15, but we are starting to see a little bit more of a negative momentum. In the intermediate term, we have the S&P and NYSE McClellan oscillator. That's been on the list, the PMO studies. And then the Swenlin trading oscillator based on price. Haven't seen that in a long time. And the percent B. This is the third day now that it's been below that lower band. In the long term, believe it or not, and we're seeing some interesting action on the moving averages that I'll show you when I get to the charts. We actually went up a little bit with the 150-period simple moving average, and we're back to looking extreme positive with that. And I went through this scenario before. This is all in doubt right now, that the Fed is likely done raising rates. That's more established. Then what's even a little bit more uncertain is, are they going to be able to cut rates? And I'm seeing more and more headlines here and there that it may be into 2025 before the Fed even considers cutting rates. The dollar was down and interest rates were down. This should have given some support to stocks. It probably did when stocks tried to bounce up. It just didn't last. We ended up closing at 4.59% for the 10-year yield, where we had been at 4.66%. We're still inverted with our yield curves. Sentiment is still negative. We're dropping even further. We're down in getting a reading at 35 where we had been at 38. Our trend is negative and starting to get stronger. The ADX is above its moving average. The ADX is starting to cross above 20. not quite, and not an awful lot of conviction yet. So I haven't changed this here. Our bias is negative with the down day, and our momentum over the last number of days continues to be negative. The economic reports, we just had the weekly MBA mortgage applications index. It came in up 3.3%. Last time it was up 0.1%. And here's the chart. So it's actually kind of a surprise with interest rates going up and to see mortgage applications going up. Usually we've been seeing kind of the opposite of that. Maybe folks are using their tax refunds or something to go in and get mortgages. I don't know. Some Isabel Net blog charts. This is put up by Real Investment Advice. This takes real S&P 500% deviation. Real, again, takes into account inflation. And it just shows the deviation from exponential growth trend. When we get above this zero level, this is a detrended type of chart. When we're above zero, it's getting extreme positive. When we're below zero, it can be getting extreme negative. And it's still showing that we're pretty high here. Then here's another chart, longer term, a weekly chart of the S&P showing you the cup and handle and then the breakout. And now we're starting to pull back. I like to show this chart just because they're different than the charts that I show to give you a little bit different perspective. Then this is looking at the earnings per share, and it's tracking a typical non-recessionary year revision trend. We follow the yellow line here. This is the historical average. And as we go through and get closer and closer to these earnings reports actually coming out, we do tend to see that revisions to earnings per share are coming down, showing that they're really optimistic when they look out. And then when that report gets closer and closer and closer, they try to bring it closer into reality. And we tend to see more of a revision to the downside. And then you can manipulate this a lot of different ways, where the yellow dashed line here, this is if you take out COVID, the great financial crisis, and Y2K. Remember that? That was roughly 24 years ago when everyone thought the world was going to end because we were switching over to the year 2000. And this is what the Bank of America is estimating will be in 2024. And then this blue line, this is what they're estimating it will be in 2025. And these things change all the time. We just look at this to get some perspective. And then we're seeing that privately owned housing units, the permits, when this really starts to decline, and it did decline, sometimes that's a precursor before we go into a recession. Now, we're not really seeing any real dive over here on the right-hand side. We just want to keep an eye on this. And then small business optimism, it's at an 11-year low. These are where most people work, is at small companies, and they're just not seeing an awful lot of optimism. We got the report not so long ago. This is kind of confirming what we saw in that report. Couple of charts here. David Keller had a post. He had been watching that 50-50 level. I mean, it's kind of interesting. 50-50. We're going to go up 50%, down 50%. And this is not updated for Wednesday's close. This is something that I took that was pretty much after Tuesday's close. And he says, since late February, we've been focused on the 50-50 level as a line in the sand. Well, we've broken below that now. Anything above that level is a brief pullback. Anything below it brings a high likelihood of a deeper drawdown. Currently trading lower and a close below this level, that equals something quite bearish. So if you are more positive on the market, you're finding this kind of discouraging. If you're looking more bearish right now, this kind of is feeding into that bearish scenario. Then this is something that I found on Twitter from Bar Chart. And here's the tweet that goes along with that. This is seasonality. And it says, for those expecting a quick bounce in stocks, remember that the first 2 weeks in May account for the fourth worst 2-week period of the year if you go back to 1950, according to Goldman Sachs. Now, again, you can twist these numbers around, election year, non-election year, going back to 1980, going back to 1953, whatever. But according to this chart, we do see some weakness in the first part of May, according to what Goldman Sachs has found. And then I wouldn't waste my time looking at this. Jeffrey Hirsch from Stock Traders Almanac posted this. It just says the S&P 500 average election year drawdown is 13.07% since 1952. In 11 of the last 18 election years, the drawdown was less than 10%. And he's using this whole spreadsheet of information to justify what he's saying. So even over the years, people think, well, it's an election year. We should be up every day. You know, it's positive. People are more optimistic. Well, we still have drawdowns even during election years. And what he's saying here is that the average is 13.07%, and we're not even close to that yet. So it wouldn't necessarily be out of the norm nor change everything if we do see a more substantial decline. We're looking at these cycles here where it does appear like we're going down here, and that tends to bottom out around the 24th of April. Here's our intraday chart. Had a higher open, you know, looked like, okay, maybe we're going to buy the dip here and send things higher. Well, we topped out right here at R1, and then we pretty much were defensive from that point on. We came down to the daily pivot. We went negative below the unchanged level, fell below S1, came down. We did find some support at S2, tried to bounce up, got above S1, came all the way back to the unchanged level, and it looked like, okay, maybe we're going to see some late day buying, but then it trailed off and we closed just a little bit above S2. Here's our intraday chart where things tend to be more optimistic before the market opens. And then once the market opens, that's when we're seeing the selling coming in. But we're still, even though these are on different scales, we're still seeing the blue line above the red line. So growth is still holding up a bit better than value intraday. But we're seeing a little bit of weakness here now with our growth to value ratio on the intraday chart of the S&P, where it was holding up. Now it's starting to show some weakness. So we were down more with growth than we were with value. We were down more with growth with the mid caps and also more with the small caps. So value got hammered on Tuesday, growth got hammered on Wednesday. So we're not seeing an awful lot of an improvement here with our small cap growth to value ratio. We're declining with the mid cap growth to value ratio and with the S&P growth to value ratio. We're still seeing more weakness when we look at the ratio between discretionary and staples. Large cap growth is showing more weakness now as we drop further below the 50-day moving average. And because the large caps are not doing well, but the small caps are doing even worse, we're continuing to see this ratio go up. The Wilshire continues to show more weakness. And looking at our trend, we are starting to just barely come back above 20. We're above the moving average and the red line is on top. So a trend is now developing that is negative in the intermediate term as well as in the short term. Volume's not doing all that great. We're still below average overall. And we did get another reading here from the Investors Intelligence. It's still giving us a high reading at 3.9, where it got up almost to 4.5. Then it dropped to a little bit over 4. Now it's a little bit under 4. This is still taken as pretty extreme. And this tries to measure all the people out there that put out newsletters and have websites, and are they bullish or are they bearish? And you still have a lot of these people that really preach buy the dip type of things, and they're still doing that. Well, if that continues to be leading to a lot of frustration, we're likely to see this ratio continue to go down. The Ulcer Index, a fear gauge, continuing to go up. And we actually declined with the line chart with the VIX, and we declined with the bar chart as well. But we've really been spiking up here with the VIX. And I have an interesting chart to show you in just a second with that. And the volatility of the VIX is also continuing to drop off. So maybe the VIX was getting a little ahead of itself. Now, this is put out by Tom Bowley, and I was watching one of his videos the other day. This is a bit outdated. This was done at the end of 2022, I believe. Maybe at the beginning of 2023. Well, here it's dated up here, November 2023. So maybe it's not as old as I thought. What he did is he went through and looked at what happens based on where the VIX is at. And when we have really low readings, because we say this thing, you know, when the VIX is low, it's time to go. That means stocks are probably topped out. Well, he didn't find that. When the VIX is giving us a very low reading, usually 13 or below, the annualized return is 47.26%. If the VIX is trading between 13 and 17, the annualized return is still quite positive, but it drops from 47 down to almost 31%. When we get up to 17 to 20, the returns even drop further to a little bit over 15%. But when the VIX goes above 20, we see negative returns. So this is why we watch the VIX. When we have low readings, it doesn't necessarily mean that we sell everything and just say, okay, and the market is topped out. You would miss some really good gains if you did that. Also, since we're going up with the VIX right now, we want to be careful of this buy the dip mentality because the VIX can still continue to go up. And trying to find the top or the bottom of the VIX, yeah, it would be easier to pick the exact top and bottom of the market. Then the momentum of the VIX continues to be up as we're getting into the 18 range here. So if we go back to this, we're into this area where we still see annualized returns that are positive, but they're dropping off from where we were for a long time down when the VIX was giving us very low readings. The equity put call ratio, look at this, just spiking up as we're starting to break below support and starting to cause some concern. And so we're seeing a lot of people buying puts instead of calls, and they're probably using those puts either to hedge their positions or to actually make a profit because puts go up in value as prices go down. And so we're seeing a real turn up here with the equity put call ratio based on 5 periods. That's negative. The volatility risk premium ticked down a little bit, but we're above this upper band here, meaning the volatility is still quite high. We came down a little bit with this fear gauge, but also it's been giving us a high reading. We continue to go up with this other fear gauge. And then our advanced decline line studies, they're continuing to show deterioration. They're not going down to this moving average yet, which is a longer term moving average, but we're seeing a lot of across the board weakness here. We're going down with our new high, new low studies, both with the 5 period and with the 10 period. And we're looking more negative with the advanced decline ratios. Accumulation distribution. We're not seeing a lot of smart money coming in and actually buying. So this is dropping off. If anything, they might be doing some selling as we're seeing some weakness in this indicator. Chicken money flow also showing more weakness. Now, if we continue to go down, eventually we might get to a point of an extreme negative reading here. We're negative with the Chaikin oscillator. We continue to be negative with the cumulative NYSE advanced decline line. We're still below the moving average with the NYSE regular advanced decline line. Also below the moving average with this other regular NYSE advanced decline line. We're declining with the NYSE common stock based on price and volume. So broad market and more specific polar negativity is what's going through the market right now. We're dropping further below zero now with the NYSE new highs minus the new lows. We're declining with the cumulative S&P 500 advanced decline line based on price and volume. We're dropping below zero with the S&P 500 new highs minus the new lows. It's the first time in 2024 we've seen that. So our 50-day moving average is starting to decline, but it's still above zero. And here's another look kind of at that same thing. We're also dropping more negative here. We are below some shorter term moving averages with the NYSE common stock, S&P mid caps, and small caps. Some weakness that a lot of people were just not anticipating. And this is starting to kind of build up now and turn things quite negative for the time being. Short term, we continue to fall. We're wondering, are we going to find any kind of support in here? We're below that 50-50 level that David Keller was pointing out. So are we going to come down to this pivot point here? Are there other areas that we may be able to find some support? And we are still below average with volume. We're continuing to decline on the short-term basis with our 20-period double and triple exponential moving average study, and the lines are going down. We're still extreme negative with the Stochk RSI, but we've been here for a few days. We're also extreme negative with the Williams percent R, and it's been stuck there for a few days. The CCI 14 and the CCI 20 continue to be extreme negative. We're still extreme negative with the 20-period exponential moving average, which is kind of strange. We were down with the S&P, but this actually turned and went flat. We're getting extreme with the boom indicator. We're getting pretty far away from that 20-period moving average. We're looking a little bit more negative in the intermediate term as we drop below zero. We're also declining, but still above zero with the 200-period moving average steady. We're still extreme negative with the force index. This is the third day, second or third day that we actually closed at the Keltner band. We're extreme in the short-term stochastics, intermediate short-term stochastics, and we're negative in the long short-term stochastics. And we're just on the border between the -2 and -3 standard deviations channel, so not necessarily extreme negative according to this reading. We are negative with the balance of power. We're negative with the go, no-go system. No-go just means don't buy or sell. We're also seeing a decline with the lowest low value as the blue line on top is starting to flatten out and the midpoint is rolling over. We're negative with the TTM squeeze. We're turning more negative with our double and triple exponential moving average based on 50 periods, and the red line is dropping below the blue line. The red line moves faster. So that means that this downward move to this point is picking up some steam. And we're keeping an eye on the 50-period moving averages, which are currently in the rear view mirror. We want to keep an eye on the 100-period moving averages just in case we come down to that level as possible support. And here we are again with the %B indicator because we closed outside of the lower Bollinger Band. The ease of movement is showing that the path of least resistance continues to be down. The Erin indicator is below zero and declining. That's negative. The S&P McClellan oscillator actually ticked up a little bit, even with a down day. Is this foretelling some kind of an attempted bounce here? But we're continuing to decline with the summation index based on price and volume, and we've dropped below zero based on volume. That's turning things more negative. We also turned up with the NYSE McClellan oscillator, but we are extreme negative here. However, we continue to decline with the NYSE summation index based on price and volume. The Swenlin trading oscillator is getting extreme negative, a reading that we have not seen in over a year, according to this, based on price, and we're continuing to decline based on volume. On a momentum basis, the PMO is declining, and it's also declining when you look at it based on price and volume. We're getting extreme and turning up just a little bit with the PMOs that are rising. And again, that could be just some mathematical adjustments that are taking place here. We're extreme negative with the buy signals. We're declining with the PMOs above zero. We're negative with the Elder's impulse system for the S&P. We're negative with the parabolic SAR. We're negative with the slope oscillator and starting to get extreme negative now. The MACD is dropping below the midpoint, turning more negative after it's been in a negative decline. All of our oscillators are negative, starting to get extreme with the slope, looking more negative with the TSI, dropping below its midpoint, dropping below the midpoint with the MACD, declining with the PMO and the PPO, and our longer-term oscillators are rolling over as well. And we're still below the 50-day moving averages, wondering if we're going to come down to the 100-period moving averages. And we're declining with the bullish percent index, but we're still above 50. We're declining and also above 50 with the NYSE bullish percent index. We continue to show weakness with the NASDAQ 100 bullish percent index. If we continue to fall, we could be getting down to this extreme negative reading. The money flow is negative. The ultimate oscillator is negative. The vortex is negative. The RSI based on 9 periods is just barely starting to go extreme negative. We're declining with the 14 period, but we have not become extreme. This is more short and intermediate term. On balance, volume continues to be below the moving average, and now the moving average is starting to roll over. We're extreme negative with those stocks inside the S&P above their 20-period moving averages. We're down to 7%. My goodness, that means 93% of stocks are below their 20-day moving averages. This is a pretty broad-based decline. When we look at the 50-period moving average study, we are continuing to decline and not necessarily extreme. The 100-period moving average study actually ticked up just a little bit, but has been declining. And the 200 period moving average steady flattened out, but has still been declining. The Copic curve shows the momentum is negative. The Sean trend meter continues to be negative. We're getting a little further inside of the Ichimoku cloud, wondering if this will provide some support. We want to keep an eye on these fib levels in case we see even more weakness. The standard deviations chart continues to go up as we've been going down rather fast. Standard deviation does not measure direction, it measures speed based on the last 10 periods. We are negative with the Heiken Ashi chart, negative with the Kegi chart, negative with the Renko chart, and negative with the 3-line break chart. Long term, we're dropping further below this level. This support level has not held. It was really acting as overhead resistance. Now that we're coming back down, that's a bit discouraging that we thought maybe this long-term support level might hold. It is not holding, at least to this point. When we look at the 150 period moving average steady, we actually ticked up just a little bit, and we're extreme negative where we continue to decline to being actually flat with the 200 period moving average steady. And we're still negative across the board in the short term, according to the Keller model. We're looking more negative according to what I look at, but according to this model, we're still positive. And we're still negative in the short term with stocks. We're negative across the board when you look at bonds based on price. We recently turned to positive with the commodities in the long term. No changes here on the decision point scorecard. And we saw some nice blue or green when the market opened because we read this from the bottom up. But then as the day got on, we saw more red with the NASDAQ and then with oil pulling back. The equal weight is really underperforming the weighted S&P 500 index. So we're seeing more broad market weakness. But the mega caps and semis did underperform, so we saw this ratio coming down slightly. The Dow is now, it's chopping more or less sideways. It wasn't down all that much, but we're below this S2 level. We're also below the 50-day moving average. The diamonds have switched over to neutral after being negative. And when we look at the NASDAQ, we're still above this S2 level, but we're below the 50-day moving average. Will this area end up providing some support? We're right at support with the NASDAQ 100. We came down to this S2 level, but we continue to be negative with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 continues to be negative, and now we're dropping below the midpoint. That's turning things even more negative. The QQQs continue to show more weakness. The small caps continue to fall. They've actually closed a little bit below this S2 level and possibly could come down and test their 200-day moving average. And we continue to be negative with the Elder's Impulse system for the small caps. When we look at the Russell 2000 small caps, we're starting to get extreme negative with the RSI. We continue to drop below support based on price. We're in a longer term uptrend, but the momentum continues to be negative. The mid caps are still above this S2 level, but below their 50-day moving average. They continue to be negative with the Elder's Impulse system for the mid caps. Apple was down. It tried to come back up to its 50-day moving average, but since has been falling back. It's also in a downtrend. Tesla is really under a lot of pressure right now, down over 1% and in a downtrend. NVIDIA, which had been holding up a little better and possibly bouncing off its 50-day moving average, now it's coming back down to its 50-day moving average. Microsoft is kind of starting to drop a little below its 50-day moving average. This has been one of the stronger stocks. And even Meta is coming down and testing its 50-day moving average. The FANG index is still below its 50-day moving average and declining. The financial sector, which is still on a longer-term uptrend, so it's positive, but it continues to be below its 50-day moving average. The dollar pulled back a little bit, but it's still giving us quite high readings, which is pressuring stocks. Here's that longer-term look where we're rolling over a little bit, but we've really been breaking out with the dollar. Oil has fallen back as things appear to be a little bit calmer for the time being in the Middle East. And we're looking at a stronger relationship here between the S&P 500 and the rest of the stocks in the world based on 10 periods, and we're still pretty much flat with the 50-period correlation. We are pulling back below the 50-day moving average with the total U.S. stock ETF. We're starting to drop just a little bit below the trend line now with the NASDAQ 100 weekly chart. Now, this is a weekly chart, so we still have 2 trading days left to go. If we see a bit of a bounce, we could get that back. But if we close below it, not necessarily a huge warning sign. It's just showing that things are turning more negative. And also, we're continuing to go up. And it's not that the QQQs are doing well. It's that the IWM, which are the small caps, they're doing worse. So this ratio continues to hold up. We did decline with the 10-year yield, and we're going up a little bit with the 10-year based on price. And we're just not seeing much of an improvement here with our growth to value ratios. We're declining with the Qs to S&P. We continue to decline with discretionary to the S&P. And we're coming back down when we look at large cap growth versus large cap value. So with the large caps, mid caps, and small caps, we're seeing some weakness here. A few days ago when I was doing the videos, this was a point of hope that we were kind of latching onto, but it's just not following through to this point. We're continuing to decline with the 10-day average of the S&P 500 highs minus the lows. And we're continuing to decline with the 19-day exponential moving average of the advanced decline ratio. And if we continue to fall, we could get an extreme negative reading. We're also falling based on volume. We're dropping further below zero with the 5-period moving average of the highs minus the lows across the Amex, NASDAQ, and NYSE. So what's our outlook for Thursday? In the short and intermediate term, we're negative and we're still below support. I didn't change that because nothing has really changed to really change the narrative that we're dealing with. This is probably the longest list of the week. There's our weekly jobless claims. Existing claims will be coming out. The Philadelphia Fed Index, existing home sales, and then LEI, which could be kind of important to the market. And then the geopolitical events that we want to keep an eye on, just in case anything escalates that could have an impact on the market. And then we won't have any economic reports on Friday. So here is showing the reports that will be coming out, what the forecast is for some of these, and what their previous reading was. Seasonality, we are neutral to positive with the Dow, we're neutral to negative with the S&P, and we're neutral to positive with the NASDAQ. So we're not really getting a lot of help here when we look at seasonality. We are still dealing with options expiration week, where we're up 68% of the time and down 32% of the time. We're going to have a really good Thursday and Friday to lean more towards the positive side. And we're pretty much flat here. When we look at the green dashed line during an election year, we will be on the 14th trading day of the month. And as I've been trying to point out here, even though we're showing the red line, which is the top first quarter during an election year, even when this is really solid, we do see some weakness that could take us into the latter part of May. Thursday is more positive than the days that we just got finished doing. And now that tax day has passed, seasonally, we often see a bounce after this. And we're still coming up into the latter part of what Tom Bowley has found as being the positive part of April before we see some weakness and then some strength going into the end of the month. The warning signs, the equity put call ratio based on 5 periods is going up. Parabolic is negative. The bullish percent index continues to decline, as does the bullish percent index for the NASDAQ 100. We're still well below the 50-day simple moving average for the NASDAQ. The Chaikin money flow and Chaikin oscillator, those are both negative. The ultimate oscillator, Koppik curve, and vortex are all negative. Our oscillators are also negative and declining. We have fallen below short, intermediate, and even long-term support for the S&P and a lot of other indexes as well. These negative divergences are not really in play right now since we're going down, and a lot of these negative divergences are starting to come to fruition as far as price action is concerned. And we're still negative with the momentum of the NASDAQ 100. Very short list on the positive side. The long-term trend is still positive. We haven't gone down to the 200-day moving average yet. And the financial sector is still positive, but even it's dropped below its 50-day moving average. So our conclusion, in the negative, or in the short and intermediate term, we are negative and below support. We're becoming more oversold in the short term, but we are negative. In the intermediate term, we're getting more oversold, but not quite as much. And we're still positive in the long term. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.